In this problem, we're preparing a consolidated income statement, equity method with an NCI, AAP, and upstream and downstream intercompany inventory profits. A parent company purchased an 80% controlling interest in its subsidiary several years ago. The aggregate fair value of the controlling and non-controlling interest was $360,000 in excess of the subsidiary's stockholders' equity on the acquisition date. This excess was assigned to a building that was estimated to be undervalued by $216,000 and to an unrecorded patent valued at $144,000. The building asset is being depreciated over a 16-year period, and the patent is being depreciated or amortized over an 8-year period, both on a straight-line basis with no salvage. During the current year, the parent and subsidiary reported a total of $540,000 of intercompany sales. At the beginning of the current year, there were $37,800 of upstream intercompany profits in the parent's inventory. At the end of the current year, there were $58,500 of downstream intercompany profits in the subsidiary's inventory. During the current year, the subsidiary declared and paid $81,000 of dividends. The parent company uses the equity method of pre-consolidation investment bookkeeping. Each company reports the following income statement for the current year. And then we have the income statement here. A says, compute the income or loss from the subsidiary of $133,740 reported by the parent company in its pre-consolidated income statement. So we're going to start out with the subsidiary's net income of $234. And on the side over here, we'll do our AAP. We have a building, and we have a patent. And the building was $216. The patent was $144. And the building was over 16 years. The patent was over 8. And so if we add those together, we get $31,500. Upstream sales, $37,800. And so now we can calculate the adjusted subsidiary income, and I put a note here, net income minus the AAP plus the ICP, or the intercompany upstream. So minus plus, we get $240,300. And then what percent of this belongs to the parent? 80%, so I'm going to put 0.8 here. And so we get $192,240. Then we have downstream sales of $58,500. And so we subtract those out for $133,740, which aligns with this income from the subsidiary reported by the parent. And B asks us to prepare the consolidated income statement for the current year. So we have sales, cost of goods sold, gross profit, operating expenses. That'll give us net income, and then we'll break it down as the net income attributable to the NCI and the net income attributable to the CI. So for sales, we're going to take the parent plus the subsidiary minus the intercompany sales of $540,000. So parent sales plus subsidiary sales minus intercompany sales. The cost of goods sold is going to be our parent's cost of goods sold, and I want to get this out of the negative, so I'm going to put the negative in front of it. And then we need to add the downstream, which we have right here, and then subtract out the upstream for $5,420,700. So we have our parent COGS plus the downstream minus the upstream. And then we can subtract the cost of goods sold from the sales to get gross profit of $3,489,300. For operating expenses, we have the operating expenses for the year. So again, I put that negative sign in front of the parentheses to switch it to a positive for us. And then we can add the AAP for the year. And so that gives us net income of $901,800. And so the net income attributable to the NCI is going to be equal to this adjusted subsidiary income up here, the $243,300. And make a special note to this because you might, like, your instinct might be to grab the $133, but it's this adjusted subsidiary income times their, I think it was 20%, but yeah, 20% for $48,060, and then obviously the difference would give us what's contributable to the CI.